So Tom, thank you for joining us today. This is our Finance 409 course, and this course is Concepts and Applications in Corporate Finance. And in this course, I use valuation and valuation equations and modeling as kind of a lens through which we can then examine corporate level decisions under the premise that virtually all decisions made in the firm are either going to expand value for the stakeholders or contract value, believing that decisions are not impotent or not benign. So we've been going through for the last several months and looking at everything from the very underpinnings of the financial statements all the way through some relatively esoteric valuation models so that we can think about the effect of decisions. But these students have, this is now their second or in some cases their third finance course. Some of them are actively involved in our investment course with Matt Krause and with Rob Patterson, whom you may have met and know. So they've got a pretty good understanding for an undergraduate student of the finance landscape and the integration of finance and the investment markets. Mm-hmm. And so for those of you as students, Tom is not only the former chairman of Ameritrade or former CEO of Ameritrade, but is a good friend to the Gore School of Business. He is on our advisory board. I've had an opportunity to be in several venues where Tom has spoken to us, and he has a wealth of experience. I invited him to speak with us today and gave him free rein as to what to talk about, but then also gave him some of the questions that some of you had vetted through me. And so with that, I'd like to welcome Tom Lewis, and we've got upwards of an hour or so to spend with you, Tom, and thank you for being with us.
It's my pleasure. Thank you so much, Rick. It's nice to meet all of you, and I wish it was in person, but under the circumstances, this is as good as we can do. As Rick said, I worked with Ameritrade, but my experience is rather vast in finance, mostly managing companies. I was the head of technology for the White House back in the 80s, and then went to Wall Street. I was then the head of systems development for Credit Suisse First Boston, and went on to be the head of technology strategy for American Express Worldwide. I've been the CEO of 4 companies, including TD Ameritrade. I founded a carbon futures and options exchange that became the second largest carbon exchange in the world, and ran a wholesale power exchange as well. I've sat on the board of several brokers and financial firms, and I developed the environmental finance program for the graduate school at Johns Hopkins University, which ran for 8 semesters there as part of the core MBA program. So I've taught at several universities, and I've had an opportunity to work in and around finance. With all of that said, finance is a broad topic, and what I've chosen to do today with your support is to walk through kind of a perspective of the markets under the current conditions, and to give you kind of the world according to Tom Lewis right now, at least my perspective on what we're going through and when we might come through this. Several years ago, as an aside, I got deeply into meditation. I'm into that today, and I've studied at the New York School of Practical Philosophy, at the Shambhala Center in New York, at Esalen on the West Coast, and the practice of mindfulness has become very much a part of my consulting practice and training senior executives to be more mindful about what they do and less ego-driven. But I had an encounter with someone who is a leader in that, and he has a PhD in Buddhist studies, and once said to me that as you try to understand, and I am not Buddhist, as you try to understand the philosophies of Buddhism, understand that you're understanding the philosophies of a single person, and egos play into it in all of those cases. No matter what they say, there is no rigor to understanding some standards of Buddhism. There's a foundation, but the rest is subject to interpretation. I think that's the case with finance. It's a lot like Buddhism in that case. this is the world according to me. So I hope it's helpful to you, and I would welcome your questions and your interaction as we go on. Rick, I'm going to share my screen if I may.
Yes, in fact, I believe I've given you permission to do that, Tom.
Okay, thank you. Hang on.
So as you're doing that, Tom, I explain to students that the rules of finance are all set in stone, except for when they're not. So,
all right. Well, I think, you know, a lot of my career has been spent in futures and options and derivatives. And I spent the last several years, 4 years to be exact, doing all of the management planning for every division of the largest futures and options exchange in the world, the CME Group, and then working on their strategy. I can tell you there's nobody in that company that understands everything that the company does, and everybody has an interpretation.
yes.
It's just such a complex topic. So again, what I will tell you is that you know, this is my small slice of where we are in the current market. I'm going to do a quick setting of the stage. Even though you're kind of an advanced class, I think it's important for us to have the same beginnings here. And that is Robert Shiller. By the way, I'm doing this on a product called Mind Manager, a mind mapping tool. And I use this in most of my teaching because it serves as a repository for any research that I do, and I can organize this and then offer it up to the students. So I will provide a link. I put this on a server. You will have the ability to use this, access to this. You can send me questions if you have it. I will only touch upon portions of it today, but I would welcome your interrogation of the information that's here and any questions that you might have. You'll see that the progress here is that we're going to talk about finance in general. We'll talk about the government's role, the markets in general, where they are today and what's going on. I'd like to talk about valuations a bit and what happens in a recession or a black swan event to valuations for VCs or in the acquisition of particularly technology companies. Venture capital perspective today. I have some other references down here that you can browse through. I'm going to close them up right now and not reference them. If you have questions as we go through this, feel free to ask. So my perspective on finance is that it's not about making money. So I find that the people who are least successful or the ones who flame out very quickly are the ones whose motivation is to simply get rich. And finance is really a mechanism to achieve some success in companies, to make organizations do something and achieve something great. So the broader your perspective is and how you're applying finance, I think the greater your success will be. I am a real fan of Robert Shiller at Yale University, and he teaches a course on basic finance, and these are the topics that he covers. It would be impossible for me to touch on all of them. The yellow highlights are some of the few things that we're going to mention today and talk about today. If there are any other areas that you're interested in, I'm happy to chat about them. I think that finance in general is a discipline for good or evil. All technologies can be misused. Finance can be misused. I can tell you that I have seen extensive, brilliant, morally based people who have done amazing things. I've also seen cheats and liars who try to get away with a great deal in this business. And I think that a strong portion of success, particularly when things are difficult, is the foundation of morals and ethics. So it's not about making yourself rich. The successful people in finance, I found, often turn to philanthropy as an extension of their career. And they're the people that I admire most. I know that you all understand the government's role in this, that the executive and legislative branches focus on fiscal policy. This is driven by politics, mostly party opinion, who's in charge, pet projects. Today, it has been driven, in my mind, a bit too much by who has the biggest pot of money to contribute. And that's influencing a great deal of our fiscal policy today. Below that is monetary policy, which is the Fed's role, adjusting interest rates. You understand the yield curve, I hope. I would assume that in your finance classes before this, you've gone through yield curves and treasury and the role of the money supply. Is that correct?
In their macroeconomics courses, they've gone through money supply and yield curves, maybe a little bit of that in micro, and they should have seen some of this in Finance 300 as well, the basic course.
Okay, can you see these charts reasonably well? I want to make sure that you're able to see what I'm showing you, because there are other charts I'm going to show. All right, so you know, the Fed's most visible control is the ratcheting up and down of the Fed rate on short-term notes, the overnight rate. And right now we're in a period where we can either get to near zero and hopefully not to negative interest rate policies, and they all have implications. But this curve of where those interest rates go is only relevant when it's looked at in terms of its relationship to the long-term rate. It has served us relatively well. It has spiked the economy. It's kept it moving longer than anyone would have expected for this boom period. But this is one of the knobs and dials that the Fed applies, and I'm going to come back to that in a moment. Financing the government comes through Treasury bonds. As you know, the rates are not set by the Federal Reserve. These are auctions that take place, and the relationship between the short-term treasuries and the long-term treasuries is what is considered to be the yield curve. And these are the various products by the Federal Reserve. This is the typical yield curve from short-term duration notes to long-term duration notes. The question is, what happens when that goes upside down? What does it mean? If I'm skipping over this because my presumption is that you have covered this in your finance classes and economics classes. If you have questions about any of this, then please ask. Everybody okay so far?
Yep.
All right. The regulatory environment of the government in the U.S. is provided by the SEC, FINRA, and the CFTC. What's the role of the CFTC in the regulatory environment? Do any of you know?
So guys, CFTC stands for Commodities Futures Trading Corp.
Right. So the CFTC was originally in charge of controlling agricultural commodities. So wheat, corn, pork bellies, all of the things that were originally traded in Chicago for the agricultural industry. As futures and options expanded to derivatives, swaps, swaptions, swaps on swaps, all of the types of currency trading that goes on, foreign exchange, because they looked so much like the futures and options of commodities, that is now regulated by the CFTC, not by FINRA. It's still under the SEC's guidance, but it's important for us to really have an understanding of the role of the CFTC, and I'm going to show you why in a moment. So overview of the financial markets. These are the products that we deal with under capital markets: listed shares, unlisted shares, bonds, under money markets, certificates of deposit, the foreign exchange market, and the derivative market. It is the capital markets under products, company-based products, that drives the health of capital markets. Although what I'd like to share with you is kind of the relative size of these, so you can get an idea of the growing importance of the other sectors. Now, I don't know if my screen is going to share what I've just popped up here. Let me go back to Zoom for a moment. And okay. Can you see this one page now that I'm sharing with you on?
Yes.
Relative size? Okay. Each one of the dots on here represents $100 billion. So I'd like to show you the kind of comparable size in this data visualization of the various sizes of the market. So cryptocurrency right now is relatively small. It's a fraction of the foreign exchange market. The problem with cryptocurrencies is that it is an unregulated, or relatively unregulated environment. at the point that it becomes highly regulated, it will unleash billions of dollars, if not trillions of dollars of institutional funding. And I think that we're on the cusp of that happening with the crypto business. This is the relative size of our largest companies, comparatively speaking, again, each one being $100 billion. The 50 richest people in America, California's GDP, the federal balance sheet. Why has the federal balance sheet, the Fed's balance sheet grew from about $800 billion to $3.5 trillion after the financial collapse of 2007. Anybody know why that happened? So the Fed bought up a bunch of bad debts, and they hold them on the books today as assets. So these included collateralized debt obligations and credit default swaps, and all of the stuff that was causing the economy to rot. So if you go back and you look at the balance sheet of the federal government today, and you look at the assets that are being held on the book, a lot of this is stuff that can never be collateralized. It can't be, it's not liquid, and it would be questionable as to whether or not they're real assets. So we continue to take on debt on the other side of this balance sheet, showing these as assets today. And there's a bit of fiction in that. This is the size of the world's currency market, gold, and this is the size of the stock market. What I want to call out here is the size of the US stock market relative to China. We all think that China has become so big, but it is still the US that dominates this. And I'm going to show you another chart, another data visualization here to show you the impact of the value of the US companies and why our stock market is so critical to the world. This is the global money supply. So this is what is being held as cash and investments by corporations and individuals. And this is the size of debt being held. And this is one of the things that has caused the economy to become unstable. This debt that is being carried by both corporations and individuals, particularly corporations, a lot of this debt has been used for buybacks of stock. And it's put companies on a very difficult precipice, particularly the airline industry is suffering right now. A lot of the companies have actually borrowed tons of money to be able to buy back their own stock at the expense of not being prepared for downturns. American Airlines is one of the worst. They actually went into debt and borrowed money to buy back stock. Here's the size of the global real estate market, comparatively speaking. Now, what we get into is futures and options and derivatives. So what I would say as I show you the rest of this chart is if you think you can get through understanding finance today by just understanding stocks and bonds and even valuations and investment banking from the standpoint of starting corporations, you're probably mistaken. Here is the derivatives business compared to everything else. This is a $544 trillion worldwide market in trading derivatives. And I would say if I were helping to develop a curriculum around finance today, I would spend at least the equivalent amount of time understanding derivatives as I would understanding underlying stocks, and how to trade futures, options, forwards, how they're used in hedging, what the role of these devices are, how the contracts are written is critical to understanding the role of finance today. These instruments are used as the cornerstone of hedging instruments for the stock market today, and they're the cornerstone of instruments used in high-frequency trading. So a really important part of understanding finance is understanding derivatives. All right, we're going to go back to, I'm going to put the screen back onto okay.
So as Tom does this, guys, recognize that he led this with asking about the relevance of the CFTC. And so the connection here is the CFTC is the body that would have the closest regulatory oversight to this derivatives environment.
Yep. And if you're going to trade stocks, or you're going to run a corporation or participate in financial decisions, a big part of those decisions today is going to be about hedging and management of the derivatives around those products. So you know the major benchmarks being the S&P and the Dow. And what I wanted to show you is that if you look at the S&P 500 over the 90-year history of it, the trend line is always up. And no matter how panicky people become, even with their personal finances, my advice to them is always, as long as you have the staying power for 5, 6, 7 years, you can ride through these curves, and you're better off sticking with the index of this generally blended fund in today's stock market than you are by trying to game it and be in and out. And investors today do best by sticking with those indexes. If you play the game of momentum and think that you can beat the market, it's relatively impossible. Here's the one example that is most often used, which is Apple. If you were to have purchased Apple around 2000, around the beginning of this millennium, you would have initially done very well.
Within Tom?
Yep.
It's still on the visualcapitalist.com screen.
Thank you. Thank you so much. Let me go back. So it says that tell me if you're seeing it now.
We're not, Tom. So I'm going to go ahead, and I think I can. We're going to stop sharing your screen for a moment because maybe we've locked up, and then you can start to share again. Let's see if this helps us.
Okay.
So I'm going to come off here and then stop share. And now let's see if you can reshare yours.
Okay, I'm going to try to share my entire desktop here. And you're going to be seeing yourself in the picture. Does that work?
Yes.
Okay, that way whatever I pop up on the screen, you'll see. So here's Apple. And at the beginning of 2000, if you were to invest in that, you would have seen a significant bump and your confidence would have been high. If you were to have asked your parents to mortgage their house and use their money, they would have been very proud of you. Within a year, the value of that investment would have dropped by 3 times, and it would have stayed well below its initial value until about 2005. At this point, to the peak, that investment would be worth 40 times what it was. But predicting that would have been near impossible, right? So playing the game of believing that you can beat the market and have enough knowledge to do that, I've had armies of traders reporting to me. I've watched the evolution of programmatic trading become algo trading. I can tell you there are very few people that have enough insight over a long haul to be able to beat the market inside and out, and day trading is a fool's game. My recommendation to anyone in the market is to stick with the indexes. 70+% of the market today is being run by algo trading. It's machines making the decisions, and they're out there ahead of you. So it's relatively hard. You can pick some of the core kind of those who are good at fundamentals and bet on those companies over the long haul. They'll do well. If you want to play the game of being a venture capitalist, invest in new companies, I think it's relatively difficult to do. The average stock returns over the life of the S&P are around 10%. So sticking with something that's in an index is probably a good decision. How many of you are familiar with black swan events and what they are? Are you familiar with the term?
You can just nod your head or shake, guys.
Okay.
No, not really.
Okay, so black swan event is an unforeseen event in the market that disrupts the market. And it was a gentleman who worked at Credit Suisse, First Boston, when I was there a number of years ago, who was a greatly recognized scholar who wrote a book on black swan events. And these are the major disruptive events that have taken place all the way back to the 70s in the market that have been disrupted. Disruptive. So you can see the global financial crisis, you can see the 9/11 attacks in here, and you can see the damage that it's caused in the market when those black swan events happen. So today we are in the midst of a black swan event, this COVID-19. That's important because every one of these, regardless of whether they are causing a recession or a bear market, disrupts the market and causes it to go down. The question is it a black swan event that will immediately cause the market to come back up after that event is over? So SARS was relatively short-lived and the market continued its trend. But this is a relatively deep move. Already we're down almost 30% in the stock market. The question is, how deep will it go and how long will it last? Okay. So the current equities market, trying to understand the depth of the problem, is these are the stocks that have been hit today in this market. And what I can tell you is that it's practically everybody. If we look at the ones who are considered winners, they're short-term winners for the most part who play a role in the recovery, providing medical supplies. Zoom is doing extremely well during this. But for the most part, the world is suffering through this. This is not something where you can second guess it. On Wall Street, there's a saying, don't try to catch a falling knife. So people believe that they can in fact buy at a discount and then ride the market up. If you believe that, I would not do it at this time. I think that we are still in the depths of this market cratering. So what is the outlook? Goldman Sachs has published a view of, let me ask you a question. What's the difference between a recession and a bear market? You guys are finance guys. What's the difference between a recession and a bear market?
Well, by term, a recession is 2 consecutive quarters where GDP has decreased, and a bear market is, I believe, when the stock market drops by 30%?
20%. Yeah.
20%.
Yeah. So one is, and are they related?
I think somewhat, at least, like.
Yeah. So there is a correlation. They are not always. There's not always a direct correlation, but almost always, the fall in the stock market will lead to recession if it's deep enough. So one of the things which I'll let you peruse on yourself in this mind map are some charts that show the average contraction period, the average expansion period, and the time between them over various times. And it's helpful to understand that this is not something that's going to last forever. You can even see the depths of the Great Depression and the duration of that as far as the recession portion of that. Here is a history of the bear markets that have taken place for, I suspect it's about 50 years here, maybe 90 years. And you can look at all the statistics around that. What I would like to show you is this chart that shows the relationship between the two. This is a chart that was published, a series of charts that was published in the New York Times about 2 weeks ago. Do recessions always follow major stock market downturns?
And Tom, we're not seeing that graphic yet.
Okay.
There we go.
Okay. So obviously we're having some difficulty with the sharing as I change from item to item. So if that happens, just tell me. What I wanted to share with you is that this shows, the last chart in this set shows the relationship between bear markets in the tan bars above, and the changes in the blue down below, which are the recessions that have followed. And you can see that the recessions don't necessarily, the periods of GDP contraction do not necessarily last as long as the bear market lasts. So we may be in a period of time where there is hiring that starts and the economy gets back and going and starts its uptick, even though prices of stocks continue to decline. All right. So the falling prices of stocks should not be something that causes us to lose confidence in the economy overall. So here are my observations. There have been 12 recessions since 1945. The average one is 5.9 years. The average duration of a recession is 0.9 years. Therefore, on average, the time between the end of one recession and the beginning of the next one is 5 years. So we have been long overdue. The last recession ended in 2009. Using the law of averages, we should have hit a recession in 2014. It didn't happen until this year. So we were way, way overdue. Statistically speaking, there was a 2% chance that the boom that we have would last as long as it would. So we shouldn't be.
Sorry, I have a question because.
Please.
So this recession happened mostly because of coronavirus, but if this didn't happen, do you think there would have been a recession, or this trend of going up would have continued until something else happened?
I think we were overdue for a recession. I think that both because of prices in the market, but even more importantly because of corporate debt and what was going on with corporate debt. And it's been called out by economists for about the last 2 years that it's coming, it's coming, it's coming. So we have a black swan event, which was a catalyst in causing that recession to happen overnight. But I believe that recession, whether it happened this month or in 6 months or in 8 months, we were on the precipice of it anyway, and this has driven us to it. So It's the combination of the market calling for a recession. It was time, and the simultaneous event of the black swan, which is the virus infection.
Okay.
All right. So when you ask the question about the recession, here's the most telling predictor of recessions, which is the predictive power of the inverted yield curve. And what they do is they take the 10-year Treasury rate and they plot that on one line. And then they take the 3-month interest rate and plot that on another line. And you can subtract one from the other. And at the point that the 10-year Treasury is less than the short-term Treasury, we get into the area called a negative yield curve. So what does that mean? What happens when confidence goes down and people are not really confident in the auctions of bidding this up, and the returns for those long-term Treasuries go way, way down? Why is that happening? Why does the yield curve invert? It happens mostly because of a lack of confidence and uncertainty about the future. So this is the indicator of market fear about the future. And if you plot these, as we're approaching this negative yield curve, these points at which the difference between these two starts to go negative, you're almost certain that we're about to move into recession. This is the greatest lead indicator that we have. It's not perfect, but it is pretty darn close to predicting recessions as they occur. So one of the items to watch if you're in the stock market, or you're leading anyone in finance, or you're making decisions about making investments in venture capital, is to watch the yield curve, the shape of the yield curve.
Question for you.
Sure.
So with the yield curve, that went inverted. I believe it was around like mid-August when it first went inverted
Right.
for the first time. How do you know the time frame, I guess? Because if you would have told someone, even in September that stock was going to drop, they probably wouldn't have believed you just because of how well things were going. How do we know kind of the time frame of when it becomes inverted for when we should expect things to fall?
I can tell you that institutional investors were already hedging dramatically. They were buying, puts and calls on their stock well into this thing tapering down. So you're correct. If your discussions are with individual investors who believe that everything is hunky-dory, their confidence, as long as they see prices rise, is to hang on. But for the most part, particularly the algo shops, the degree of hedging that they did as this declined increased dramatically. They were shorting. The number of shorts that they purchased were significantly increased during this time. And most of the institutional investors at large banks were heavily leveraging their positions or moving out of equities during that time into something more stable. Okay, so we may not see it and we may not read it in the Wall Street Journal. There are lots of clues, lots of hints. And I think one of the things that will help us to be successful in finance is to somehow begin to develop the knowledge of the institutional mindset rather than the individual investor mindset. The more we can get attuned to that, the more accurate we'll be able to guide companies that we lead. All right. So here's a chart that shows the declines in the US market over time. This is the percentage of decline from the previous peak in the S&P and the NASDAQ at various periods when there were huge market dips. So this is how far down from the peak the market dropped at various times. So at this point, when this was done, which I think was in the middle of March, we were down 22%. I think we're down about 30% right now. What's your guess now with this? This is an institutional perspective. What's your guess as to how far this will go? You have a recession and you have a black swan event with massive unemployment, the largest unemployment that we will have seen since the Great Depression.
I think more than 2008 for sure. It'll go more than that.
It could very well. And I think that's the challenge here. None of us really knows, right? We don't have a crystal ball. We're speculating together. My guess is it probably goes well below 50%. It could go as low as 60%. But I hope not. And the sooner that we find a cure for this, the more we will get into reasonable recession recovery time. And that is probably a couple of years. The challenge that we will have in this economy is the absorption back into the base level of our economy, the service layer of our economy. How quickly will people go out to eat again? How quickly will they travel again for leisure? How quickly will people get hired back into restaurants and gyms and all of the service personnel that support the economy? How quickly will those jobs reemerge after they've been hurt? And so I think that the recovery is going to be a little bit slower, a little bit longer, and it's going to be a little bit deeper. I don't know. I don't have the crystal ball, but I think that decline could be comparable to what we've seen here, maybe a little greater. All right, that's the best I can tell. But this is also interesting. This is the Asia Pacific Composite Index in Japan. And you can see that Japan had been going through rapid declines, mostly because of their manufacturing declines during this period of time. This is really telling about what's hitting these economies. Asia Pacific, a bit lumpy. Let's look at China and the declines that they've had. For the Chinese economy, I would say it's not really a fair indication of the market interest. The declines are more global lack of confidence in investing in Chinese businesses because of government control. So those are the declines that you see in the market here. But they've already taken a huge hit. For China to go down further in this, they've been able to really kind of cover up what's going on with this. They have a lot more ability to directly control the optics of their economy. And I suspect that the impact of this, even though they will be in a recession, is not going to be felt as deeply. I won't go through the other countries. The one that is interesting is Saudi Arabia. Why has this happened? What's your speculation on all of the huge drops in the value of Saudi-based equities over that long of a period of time? What caused that? Oil, natural gas. It was fracking in the US that was so disruptive, and it was world markets and the competition with Russia. But the oil business within the Saudi Arabian government suddenly did not become as important as it was to the rest of the world. And all of the investments that they had around that, all the equity investments suffered accordingly. So it was very telling to see that huge, huge hit that Saudi Arabia is taking in the global economy. So let's talk about the math of recovery. So the basic math of getting back out of a recession is it's harder to climb out than it is to fall in. If the market declines by 50%, so here the equation is if A times B equals C, right? So, and A is the market itself, and it falls by 50%. The question is, how much does it have to rise to keep C constant, which is the value of your original investment? So you put money into the market, and the market falls by 50%. How much does the market have to rise to get back your original investment?
100%.
100%. So now we're not talking about getting back 50% in the increase of that. It has to be a staggering 100% to get back to that. The good news is that it seems to happen relatively quickly. And if you look at any of the charts on the incline that I showed you originally, and we'll go back here really quickly to show you, let's see. If you look at these charts, for the most part, what happens is the market picks up right where it left off. After it gets through the dip, it picks up on the same curve. It doesn't stay down here. The climb is relatively rapid once that recovery starts, and we find ourselves back in the middle point relatively quickly. So the question is, how long will it be? And my belief is that we're probably looking at 5 to 7 years on that. I'm not going to spend time in the fixed income area and the debt area, only because it's a dead market right now, and I don't expect it to improve greatly on the short term. The derivatives market, I would advise you to learn about that, particularly for hedging. Let's talk about valuations. How is our time?
We're probably coming up within about 5 minutes of when you want to do some Q&A.
Okay, great. Let me just hit on some points for valuations during a recession. So during the dot-com recession, Apple's revenue multiple fell by 89%. Amazon's revenue multiple fell from 12 times revenue, 12 to 16 times, to 2 times. This rapid collapse. During the financial crisis, Google's revenue multiple fell from 12 to 16x to 4 times. So as these revenue multiples collapse, is it really fair to use multiples as the assessment of value is the question. Is that the way that you should value investments? And you're in the middle of doing valuations now. I saw that. What are your thoughts about that? What should we be looking to?
So guys, what alternatives do we have to using multiples?
Will be the cash flow growth.
Obviously, you know, I'm leading the jury here a little bit, but the answer really is cash flow. Cash flow, I would say, is being even more overshadowed by the value of intangibles. Can you tell me if you can see the screen that's popping up now?
Yes.
Okay. This is one of the most powerful data visualizations that I have seen about the value of intangibles over time. So here are some examples, and it may be difficult to read on your screen. I'll make this as large as I can, but when you have access to this, to the link that I provide you for this map, you'll be able to pop these things open on your own and look at it. But the value of intellectual property, the value of the brand, relationships with customers, the ability to accumulate data for marketing purposes, non-revenue rights that you have to products, business-to-business sales, all of these things have become increasingly important. If we look at the top 5 companies that were in existence in 1975, they were almost all valued based upon what would be considered the fundamentals of the business. A multiple of revenue would have been reasonable. As you look at the top 5 companies today, the value of their intangibles, whether or not they're profitable, far exceeds the estimated value of the fundamentals. So here are examples of various companies, and some of them, like Pfizer and Unilever and United Healthcare and Walmart, you will see there is a higher valuation given to the tangible value of the company. But as you get down to the bottom end, Microsoft, Amazon, Apple, Alphabet, Facebook, AT&T, the value of the intangibles is greatly increased. And that trend is continuing. Why is that happening? Have we lost our minds? Why are we suddenly valuing all of this differently than we did years ago?
Well, I think part of it has just to do with the fact that, like, through technology and other things, there's more value added to, like, services and the ability to utilize technology than just your capital components.
What you're exactly right. What this represents is the emergence of the information age. It's not just the technology age. It's the value of information and the use of information. Hence, as this continues to grow, things like artificial intelligence will increase the value. The ability to continue to accumulate data will increase the value. All right. So in venture capital, the current situation is this. VC firms have raised over $100 billion in the last few years, and they have vast amounts of uncommitted capital. The market's been good to them. They've made money during this boom. But the challenge that you're going to find if you're starting a business today is that they're going to be investing that money mostly in their existing companies in their portfolio. So this is what happens during a recession. During a recession, this is the trend in technology IPOs, from profitable to unprofitable. So over the years, from 1980 through now, 2019, I think this is the last record here, what you've seen is a trend of more and more IPOs going out with companies that are not profitable. Why did that happen? Remember, the previous chart is the value of the intangibles, that people give high value to that. But what happens here is that this line represents massive shifts, what they call the squeeze that takes place during recession periods. So here's the 2008 recession period, where suddenly less companies, it's not a straight line, less companies that are unprofitable now are able to get an IPO. Now, here's the squeeze of 2019 and 20, and you see the line going up again. So less companies that are unprofitable will be able to go out. Why is that?
Because they're sure that, like, those companies that are less profitable, they're sure that in a recession time they're for sure not going to make any money. Or
Just like you and me, if we have uncertainty during a time when we have limited money, we're going to invest our money in the ones that are most certain. And this happens not only with IPOs, it happens with venture capital money. As soon as the recession hits, the money shifts to their existing portfolio rather than taking more risks. And they'll try to shore up the companies that are in their portfolio more to make them more successful, because that's where their money will pay off better. They would rather have a small bite of something that has a higher probability of success than they would by taking chances on something that's new and risky. So this change in the economy will greatly affect the value and investments and the ability to go profitable. There's one more chart I'll show you. I wish we had time for much more, but I think this is critically important. One of the growing popular decisions in making decisions for investment around the capital markets, particularly in first and second stage investing, is this rule of 40, which has been characterized by Bain and Company. And that is what they now look at is the combination of EBITDA margin, the profitability of the company, and the annual rate of growth of the company. So they plot the rate of growth here, year to year. What's the rate of growth for the company? What's its average rate of growth, annual growth? And then they plot their average profitability here. And here you can see what they're saying is it's called the rule of 40. And that is the sum of those two has to hit 40. So here is zero revenue growth for this company, but they're at 40% EBITDA. Here's a company that is zero EBITDA, but they have 40% annual growth. About 40%, just by coincidence, of the companies that are in the tech business fall above this line. At the time that people have to pick high probability, successful ventures, they will stick above this red line. They will avoid those below this line. And this is a high determinant of success and becoming more and more an acceptable standard of how to determine success of technology companies. And it's being applied outside of the tech business as well. So as you look for money to flow, it's being tightened up. It's being put into those who are profitable, those who are leaning toward relatively high EBITDA, good long-term growth, and you'll see both venture capital and you'll see IPOs shifting to those firms during this time. So the money is going to be tough for VC decisions, but there's a lot of it out there. Your story just has to be better. All right, so there was a lot more to cover, but now I'd be happy to take your questions. I have written down the questions that you had, but Rick, I'll leave it to you to determine how you want that to proceed.
Well, I'd be happy for a few of you that might have some questions from Tom's discussion to go ahead and offer them. To do this, go ahead and we'll come off of sharing, Tom, so we can see everyone that's with us. And if you've got a question, I'll ask that you raise a hand so that we don't compete with each other. And I'm going to go ahead and bring us into in gallery view because so we can see everyone and hands raising. And I see that a number of you, we're not going to see your hands, so you may have to go ahead and open up your video to see this as well. And so with that, any questions that you might have for Tom at the moment? Megan, you'll have to come off of mute.
So I was wondering if you could comment on the relationship between the real estate market and the stock market and bond market, because in 2008 it was a little different because the recession was kind of based on that. But how does it usually relate? Because you would think investors would be looking for a place to park their money with low investment rates or low interest rates. But if unemployment is high, they might not have the money to do that.
Well, I have to start this by saying I'm a real estate idiot.
Oh, okay.
So I of all of the capital markets, I have a little bit of knowledge of insurance. I ran technology for a property and casualty company for a while, and risk, but my knowledge of real estate is really dim. So I probably am not the best person to advise you on that. I just don't know.
Okay.
Yeah.
So Megan, let me suggest that real estate tends to move in value more as a function of interest rates, how expensive it is or isn't to be able to get a loan, and employment rates than it does stock values. But sometimes those are correlated.
Right.
No, I have a question.
Please, Victor.
Tom, thank you for a good presentation. And I have a question for you about your insight of the Fed's $2 trillion package, what they announced here a couple of days ago. That how do you think that this will play in the capital markets? That will it increase money going into the capital markets, or will it only go to savings? And will this have sort of an impact not only on the short term, but in the long run?
So I'm glad you asked that question. Please know that this is purely opinion here, but my gut is that we wasted some precious bullets here. That it was done too quickly with too much of an emphasis of bailing out some of the large people that shouldn't have been bailed out. If you look at one of the sections you'll be able to peruse on this map is what happened it's buried in one of these, the references down at the very bottom in other links, is what has happened in buybacks. And a lot of these corporations over the last several years have used stock trade buybacks as a means of enriching the CEOs and their boards. And in my mind, it's something that's really unsavory. There is a time Warren Buffett is a real advocate of stock buybacks. He of course is, because he's an investor. And as the value of his shares goes up and he can remarket and resell those shares, he makes a great deal of money. But I'm not so much of a believer. And if you look at the airline industry as one example of the need for bailout right now, and the hotel industry is another one that have learned to charge exorbitant fees and use their stock internally to inflate, without regard for the fundamentals, the value of their stock, mostly related to compensation. And the compensation that results from that, they were unprepared, as the banks were unprepared in 2008. So the question is, do we spend $2 trillion now bailing out those companies, or do we make them loans and debt and tie it to some performance measures? And the more we tie it to what I would consider to be proper behaviors of the stewardship that they have as public companies, we all hold stock in them. We're co-owners of those companies. And if they violate that stewardship, they hurt us all. So what I don't see is a focus on correcting behavior. What I see is the ability to hand over money that may create some of the same behaviors going forward and reinforce those behaviors. If that money was used mostly to help the people at the low end who are displaced by this, I think it would have been far, far more effective to cause, we're a consumer society today. A huge portion of our success is based on consumer goods. If we were to use that money effectively and apply it where it would have kept the consumer economy alive till at least the epidemic is over with this virus, I think it would have been far more effective than immediate bailouts of vast sums of money. The other problem that we have is we already gave away $1 trillion in tax cuts. And then you add to that our debt, the assets that we're holding are really weak, and the debt is exorbitant. It's your generation that has to solve such things as climate change and reckless spending. And somehow, some way, I hope that you can help make that happen. And if I can do anything to inspire my children or this next generation coming along, it will be a greater focus on making the whole work and not the disparity at the top. I hope that answers your question.
Yeah, thank you, Tom.
Yeah.
Anything else, guys? So Tom, one of the questions that one of our students had sent in that I believe I sent you by email had to do with entering the job market in a recessive period. And these students, of course, will enter the finance job market. What comments would you have with respect to entering that market, how to prepare themselves, or maybe even alternatives?
Can I share screen one more time?
Oh, please.
Okay. So let's go back to tell me if the map is showing.
It is.
Okay. So what I wanted to share with you is this. And what you'll see on these topics is that there are URLs connected to this. There are documents connected to it. Every icon that is next to one of these things when you get this map has something of value that you can explore. These are the top 25 college majors in Kiplinger this year, and they are ranked by the ability to get a job and how well they pay and the future of those careers. I highlighted the top 10. Out of the top 10, 8, if you count computer science, are engineering based. 8. Finance used to be way near the top, and so did an MBA, used to be way near the top. So my advice is not that these are not valuable careers. It's that the marriage of either companies that are intensely engineering and science based and your business education will yield the greatest results. So my background was computer science and business, and the marriage of that served me really well. I was 29 years old and I was appointed to be the head of technology for the White House. It was unheard of. It was unheard of. Somehow the integration of where our world is moving toward a data-driven economy and a service-based economy driven by data. The closer you are aligned to where that intensity is, the greater your chances are for long-term success and your lifetime earnings. That's my opinion. And I don't think this is a short-term trend. I think this is a couple of decades long. This wave is not going to go away. We're not a manufacturing-based economy. That's not going to happen. And maybe it's services when you see things like nursing and healthcare emerging. But look, if we go down here, look at how many of the others are still engineering-based. So I would say kind of focusing on the companies that are intensive and leaders in that, and developing skills that allow you to speak the language of what's the future. Data analytics, big data, things that will really impact the future. Your finance degree suddenly pushes you up here if you can speak that language. It's the union of the two.
And even in the petroleum engineering area, because regarding, you talked a little bit of climate change and decision that we would have to make regarding that, but petroleum
that wouldn't be my choice of career.
Yeah,
But, I have to show you the data as it is. My sense would be that I would suspect for the next few years that's going to be disrupted. I also would suspect that had we had an administration that was more prone to science and climate change, that would probably be something that would be a bit different today. And I would be prepared that it's only a matter of time before that gets displaced by other forms of engineering.
Well, thank you, Tom. You've been incredibly generous with your time today. Thank you so much.
I'm so happy to be with you. I will send you the link, Rick, and for this, the map online, and if you can share it with your students. And if you have any questions, feel free to email me. Be happy to answer any of the questions that you have as a follow-up. It was a pleasure to be with you, and please be safe.
Very good. Thank you so much.
Thank you. You too.
We'll allow Tom to go ahead and leave us, but we have a little bit more to do. So Tom, thank you so much, and have a good day.